advisor. I was the chief economist at Pemberton Securities, traveled and talked to some of the biggest money managers in the world on a regular basis in Europe and in Canada. I've advised governments at all three levels on the economy and what that meant for policy. The people I advise, I put my reputation on the line. I worked with some of the best economic forecasters in the world that built the models that all the forecasters use today. Lawrence Klein of the Wharton School and Mike Evans of Chase Econometrics and Otto Eckstein at DRI at MIT used their models in the 70s and the 80s, and they were the pioneers. I got a very good understanding of the interactions of the economy, and through my real world experience of talking to executives, to investment managers, and to individuals who have to make decisions and in trade associations, that's where I got all the really valuable information on understanding how the world works and what's likely to happen under a given set of circumstances. So today I'm going to talk to you a little bit about what's going on in the economy. One of the things that stood out, because I put my reputation on the line for the people that listen to me, is I've been able to pick major turning points many, many times. We don't have many of them because thankfully they don't happen very often. But the recession of 1980-81 was forecasted by me, and I went down and talked to the US Fed about the implications of their high interest rate policy, and they argued there wasn't going to be a recession, but they never tell you what they really believe anyways. The recession of 2008-2009, I did not forecast. There were no publicly data available on the economy that indicated there was imbalances. But when the event happened, and it was all due to these bad mortgages, and the world looked like it was falling apart and stocks dropped dramatically, I realized the world was not going to end because the problem was just bad assets on the banks that made them technically insolvent. So the Federal Reserve or the government were just going to buy up that garbage paper and recapitalize the banks, and then life moves on. In the meantime, we had a huge wave of bankruptcies, mortgage defaults that affected consumer spending. But I bought stocks from my clients at that time, knowing the world was not going to end, and we did very well. I almost tripled the value of the assets under management I had in the year and a half from the bottom of the market. The internet bubble was one that also was clear to see. People feared Y2K, so companies were investing in technology, replacing computers, anything like mobile devices, landlines, everything that had a computer in it that could possibly not function when the year 2000 came. So what happened was all of this investment that would have happened in 2001, 2002, 2003 was all brought forward, which created a vacuum in a huge sector of demand in the US economy. And that was plain to see. And that's what precipitated the downturn. At that time, I was the chief investment officer of a firm that I helped set up. And our first client was a 64-year-old man with $1 million to invest. We had to have a minimum of $1 million. And we were supposed to invest him. And it's the first time he's ever invested in his life. It was scary for him. And this is June of 2000. The markets were going up. The economy was strong. And the methodology that our industry uses suggested that he, based on all his risk asset, his risk profile, his age, his net worth, all these kinds of things, suggested he should be 67% to 70% in growth stocks and the rest in bonds. And he should have virtually no foreign exposure. I went to the head of the company. I said, you can't invest this man this way. There's no way you can do this. And there's going to be a recession. And in a recession, bonds are going to do really well. Canadian dollar is going to fall. So you want to be in foreign assets, and you don't want to own any growth stocks. You want to have conservative stocks, discretionary financial stocks, consumer discretionary stocks. Not all these tech companies that the programs that the industry uses was indicating this person should have. Well, we argued for a lot. And I kept insisting, you have to look after this person. If I'm wrong, he just makes a little bit less than he would otherwise. But if I'm right, instead of losing 30, 40%, he makes 30, 40%. Anyways, he persisted and listened to me, and we invested this person the way I wanted. And then, of course, the market just crapped out. The NASDAQ dropped 60%. The Canadian dollar fell dramatically. This man's portfolio did really well. And it's all because we had a better idea, or I had a better idea about what the future and what it meant for the decisions he had to make. Okay. Now I took the risk of being wrong, and I've done that with all my clients, and it served me well. Okay. Sometimes it costs you.
Excuse me, George.
Yeah.
You are the host, so we might have somebody waiting in the waiting room. I just
Oh, okay. Two people entered. Oh, you want me to admit them?
Yeah, you can admit
okay,
them.
Sorry. Okay, yeah, admit. Okay.
Hi, Andrew. There we go.
Another one, Yvonne. Okay. And I've had the privilege of discussing the economy with all the central bank governors Canada's had since the mid 70s, with the exception of Mark Carney, who I didn't know, and all the others I did. And Tiff Macklem, the current governor, is probably the most transparent governor we've had. He hasn't seen me since the 1980s, and he wouldn't recognize me if we crossed each other's paths on the street. But he just spoke to the Board of Trade yesterday saying things are going to be much tougher. And they can't really tell you. You know, the role of central banks and governments is to manage expectations so they can accomplish their agenda. All communications is driven by whatever the agenda of the communicator is. So when we hear economic forecasts from the major financial institutions by the chief economists, they're not getting paid to tell you what you need to know to make the right decisions. They're getting paid to make it easier for the firm to make as much money as they can. Okay, it's about risk management, and if there's a bad environment, that's why you don't have forecasts of recessions. If people forecasted recessions and it was not in the good interest of their employer, they get fired. A personal experience, just to demonstrate that, when I was chief economist at Gopal McDermott, I wrote a bond report saying that, you know, there's no generalized commodity price inflation, and that the bond desk, which asked me to give a view on bonds, because the institutional investors were all worried and said, should we sell bonds because the indicators were indicating inflation. I wrote a report saying, look, there's no generalized commodity price inflation. It's all in energy right now. So don't worry about inflation. Hold on to your bonds. Well, the company didn't want me to release that report, because when I said there's no generalized commodity price inflation, they thought, since we're a resource Western Canada boutique recommending virtually only resource stocks, they thought that their advisors were not going to buy any of their resource recommendations. So the way they dealt with it, when I said, well, look, my responsibility is bonds. And this is what my bond investors need to know. Their way of dealing with the situation was to fire me. So, you know, sometimes when you do the right thing, there are short-term negative consequences. But I've always been willing to put my reputation on the line to serve those that listen to what I have to say. So I'm going to go through I've got quite a bit of information. I know I'm not going to get through it all. I'm going to have to go a little bit faster than I would like, but I'm going to share my screen. Before we start, are there any questions you have of me, my background, or anything at all? Nothing? Okay. So share screen. Okay, so let's just see. This is covering my screen now. How can I get rid of this thing? You are screen sharing, but it's my slide. I can't get it. Can I move this thing to the side? It's covering my buttons to manage my slideshow.
Yes, you should be able to move it, George.
Okay, here I am. Okay. So there's a lot of economic uncertainty ahead. You can never forecast with accuracy because the data that we have is not really hard data. They're based on sample data. Okay, so it doesn't reflect true reality, but that's the best we have. And when more information comes in later, they revise history. So there is absolutely no precision in forecasting. What you can do, though, is if you can have a much better idea of what the future holds relative to what the current thinking is, it creates a gap that gives you either an opportunity to take advantages or to take action to reduce the risk that you face. And that's what it's about here. Noam Chomsky, who is a very famous philosopher, linguist, he's written over 100 books. He says, the general population doesn't even know what's happening, and it doesn't even know that it doesn't know. And that's true, because we get our own information from media, and media is competitive, and their job is just to report what everyone else is reporting, and they don't want to take a chance of the eyeballs leaving the screen or people not buying the paper. So, and I've been interviewed many, many times on TV and in newsprint, and I'm very aware of the agenda of newsrooms and editors when it comes to stories. If you don't meet certain criteria, it doesn't matter whether it's good news or not, it doesn't get printed. Now, Noam also says it's the responsibility of intellectuals to speak the truth and to expose lies. I don't consider myself an intellectual, by the way, but I do think my role as an economist, whose job it is to try and understand what's happening, my job is to let people know what I think is happening and be accountable, okay? Regardless of whether it's good news or bad news, okay? People do not want to hear things that they don't already believe. That's why there's no lineup of the unpleasant truths booth. And there's a huge lineup of comforting lies, right? We like to have our views reinforced, even if they're wrong, okay? That way we can always blame circumstances for things happening to us that are not very good, rather than take responsibility for our own decision-making. We all complain. Who wants change? Everybody wants change. We want things to be better. But nobody really wants to change. They want somebody else to change. They want the government to do this. They want their corporation to do this. There's a lack of personal responsibility. And the irony is that everyone took the personal responsibility and did the best thing for their life. Everyone will be better off. So really, when bad things happen, or a recession happens, or a boom happens, people attribute their good fortune or their bad fortune to circumstances. It really is not circumstances. It's the way you make decisions about the circumstances that you're confronted with. So it's really about making decisions. And virtually everything I've done as an investment advisor, advising my clients, or as an economist, advising professional money managers, or corporations that have to do capital planning and annual budgeting, it's about making the best decision possible, right? That's what it's about. And the world has changed so much, we can't do things the way we've always done. We've made changes with COVID. Abby was talking about how the catering services are now trying to compete with restaurants by doing dinners, that sort of thing. People are adjusting. Central City Brewing started making hand sanitizer instead of beer when there's a shortage of hand sanitizers. Automobile manufacturers were making ventilators. I mean, people jumped on the opportunity to create some revenue, but it's not long lasting. It's not a fundamental change in the business to make them sustainable, okay? So we have to figure out a way of making our business sustainable, and it requires some hard thinking. And here's Jeff Bezos. He's a great example. When he started out, people didn't believe he was going to be successful. Warren Buffett did not believe the story. Warren Buffett did not invest in Amazon until recently. And when Jeff got seed capital, a lot of it from his family, he told them there's probably only a 30% chance my business is going to work. When he started the business and he was focused on the long term, Wall Street's focused on the short term. And he was getting a lot of flack for applying all his money back into growing the business and not having profits and dividends to pay shareholders. He said, screw you. I have a vision, I'm going to follow it. And he ran his business accordingly. And now he's the richest man in the world, right? He didn't listen to the people that didn't know what he was really trying to accomplish. They had totally different agendas, had no vision, did not understand. And there were periods of time where his stock price was plunging and all his business metrics of the company were going up. There was a discontinuity between the stock price and the reality, and he paid no attention, okay? And he's a result of the decisions he's made. And you can look at every great person that's accomplished a lot, it's based on their ability to make decisions, and often it's going against the conventional wisdom. So what are the lessons from COVID that we've seen? I was been talking for a couple of years about the economy weakening, and what happened was COVID just accelerated because there's underlying rot in the economy. Consumers were over levered, governments did not have good policies, companies had weak balance sheets, were underinvesting. All of these things were undermining the productive potential of our economy, but no one was paying any attention. You get a news story about it, it lasts for 30 seconds, and then it's never talked about again. People are not encouraged to connect the dots. But the COVID here has really fundamentally revealed the shortcomings. Another very important thing, though, is cooperation is much more successful than competition. If you look at that analysis, you look at what's happening in the US in terms of the COVID spread compared to Canada, even though we're in a second wave, when everyone doesn't worry about whether they're helping their neighbor or not, things go haywire. And in business, big business cooperate to the tune sometimes of getting in trouble with the government. Small businesses do not cooperate in any tangible way. They belong to associations, which is great, like the Chamber of Commerce and Board of Trade and the Confederation for Independent Business, but there is no tangible systemic way that they support one another, whereas big businesses do. They know the value of cooperation, okay? And I'm going to be talking in another Zoom meeting about how small businesses can really cooperate with one another and the customers and overcome adversity in the economic environment and make this businesses sustainable. So really, when you cooperate, everyone wins. They don't win equally. That's not the idea, but they all are better off than they are when they're not cooperating. Governments, we know, will act together to stem the crisis with whatever it takes. Right now, we've given them a blank check. Before we worried about budget deficits, now what are they? It doesn't matter. We've got to stop this virus, right? We'll deal with the future later. We've also noticed that, you know, we're not islands unto ourselves. Individually, we're interdependent. Like Canada is interdependent globally. Provinces are interdependent. Our degree of connection to one another, which we paid lip service to, has been brought to the fore, where we're all impacted by the actions of others. And globalization risks were ignored. We saw that with supply chains, and now we've seen a desire to have a lot more production at home. And very importantly, the focus on the short term rather than planning for the future has contributed to the severity of the crisis. Consumers did not plan for the future. I've had a lot of my investment clients empty their RSPs to finance the current lifestyle, thinking that somehow I'm going to make it in the future without having any plan. Corporations have done the same thing. And so our lifestyle and our business operations have to change. And doing the same thing is just not going to work. We have to plan for the future. We have to make greater use of technology and cooperation. Those are the keys to success. Excuse me. So now here we go. We've heard the term the Great Reset. Trudeau has used that term, the Great Reset. Question is, what does it mean? It's not specific, but there is the adage, you don't waste a good crisis. When people are all suffering the same problem and the focus is on dealing with that problem, you don't pay attention to the other stuff. So if you have an agenda that you would like to put on the population and they wouldn't accept it under normal times, you may be able to skate it by when they're not paying attention. Consumers and businesses have abdicated their responsibilities and left a wide open field. You know, I've told business executives for a decade, they complain about the government intrusion, but now they all want the government to bail them out. And when they're bailed out, they want the government to back off again. They could have made themselves stronger if they'd invested the way they should have, but they didn't. Canada is probably going to become a much greener economy. We've seen that from the carbon tax. Government is going to try and reshape this economy. We don't know how, but the reality is governments can't reshape the economy. It's firms and consumers that individually make decisions that change the economy. all the government can really do, unless they want to create companies, crown corporations, and do stuff, all they can do is create a set of rules and incentives and disincentives to get the private constituents to actually behave in a way that creates the change that they want to accomplish in the economy. So we don't know what's going to happen to industrial strategy or the trade policy. There is the potential for all kinds of havoc. Okay. Now, when things don't go right, the pessimist just complains. The optimist just continues to expect change, but both of them don't take any action, right? The leader, though, recognizes change is coming and they adjust the sails, right? So you just look and you say, what do I have to do to cope in the situation and still achieve what I want to achieve and take the appropriate action? And I'm hoping that the small business community in Canada will take the leadership role in joining together in a way that I will suggest in another Zoom to secure their own individual futures and help their customers. And by doing so, create a much stronger economy. If they fail one by one through attrition in the economy has no chance to recover because their impact on the economy in the aggregate is so huge. 80% of employment is in small businesses, right? So, we have to shore up and strengthen small business. And it's not enough to say, well, this business went out of business here, but 2 weeks later, there's new business there. Well, that's basically treading water. You're just replacing a lost one with another one. There's no net gain, no net growth. We want net growth in this country from the small business sector if we're going to have an economy that provides a standard of living that we all expect. Now, the mindset of executives has changed dramatically. McKinsey, one of the largest consulting groups in the world, surveyed executives. Prior, in July 2017, 48% of respondents ranked scaling down costs as a top 3 digital priority. Look at what the priorities are today. Only 10% are in savings. 30% want to modernize their core capabilities to keep up with competitors because they know competitors are improving. Investing in more technology to make it a competitive advantage. Don't just ride on your coattails. Make some overt decisions that will improve your competitive position and refocusing the entire business around technological changes that support your business. This is the mindset of the big businesses to a large degree today. It ought to be the mindset of small business, not just surviving. And if you look at how the COVID crisis has accelerated the digitization of customer interactions by several years, this is amazing. Globally, the adoption was 20% of respondents. In December last year, it was 36, it's jumped up to 58%. So there's a recognition that digitization is really essential. And part of that is because we can't have personal connections. That's why we're using Zoom, right? But it's just a specific example of the greater use of technology to overcome the difficulties we have so we can still succeed. North America has, can I just change this one here? No, I can't. Okay, now here's another one. This is very important. Digital payments. This worries the central banks. Asia is huge. China, most people use WeChat to pay their bills. There are other digital payment methods available today. Apple Pay, or Apple is coming up with a cryptocurrency. The company that I want to talk to you that can help small businesses in my next Zoom has a means of payment as well. And this is a boon for small businesses because it'll save you transaction costs. And that's why it's being adopted by so many parts of the world. It's all about making an experience easier for the customer and reducing our costs of doing business. Visa and MasterCard have got a huge competitive threat over the next 10 years. So my message is, if you don't make the time to work on creating the life you want or the business life that you want by taking action, eventually you're just going to be forced to spend a lot of time dealing with a life you don't really want. And it's not just going to be a temporary situation, as I will show you in a minute. This is going to be for a long period of time. We're not going to be in recession for a long period, but we're going to have very tough, very competitive business conditions for a very long time. Something that we're not used to. That requires a change in the way we operate. So I'm going to talk about government deficits. We're going to talk about the investment markets and home equity. The reason I'm going to talk about those two things is because we all have our futures vested in our home equity and in our investment portfolios. You know, we save for retirement, but what's going to happen to those two sources of retirement income? Okay, and the other reason it's important is because they affect people's ability to spend and their degree of confidence. Okay, we're going to talk about growth rates, the risk profile of the business community, employment, consumer incomes, and business investment, because they all are going to be impacted. But I want first to talk about the fiscal outlook. This came out in the government's announcement a week or so ago, 2 weeks ago. The budgetary balance you'll see at the bottom in the red box is almost $400 billion in the red this fiscal year. Before COVID, there was expected to be like minus 35. So it's 10 times. Our accumulated debt for the government since the beginning of government was $450 billion. Now they're going to spend almost 100% of that in 1 year, doubling it. And their projection under a pessimistic scenario is that they're going to continue to spend 170 billion the next year and 110 billion the year after that and 70 billion the year after that, adding to the net debt. The important thing about these numbers is that when you go from 400 billion to 160 billion, that's 130 billion less. So ask yourself, if the government were to stop supporting everybody today through rent subsidy, wage subsidy, CERB, what would happen to the economy? It wouldn't all of a sudden bounce back, even if COVID disappeared. People's attitudes and psychology have changed. Businesses have failed and disappeared. So when you start taking away that degree of support, it has an impact. And the reason these numbers are this high is because there's still a very weak economy out there that's requiring them spending money, and there's lower tax revenues. But these are still huge numbers. If you look at that, you know, the debt this year is expected to be 1 trillion compared to the 458 that we had at the low, and 450 billion accumulated debt we've had just recently. It's just phenomenal. Now let's talk about the investment markets, because there's something in economics called the wealth effect. People are earning an income, and if their stocks that they own in their RSP or in their tax-free savings account is doing really well, they feel much more positive and they spend more than they make. If their portfolio is sinking, they feel poorer, and sometimes they don't spend as much as they would otherwise. When your home equity is rising, you feel wealthier. You know that you can tap your line of credit to finance consumption. You can buy a newer car, you can buy a boat, you can do this. You feel wealthier. But if your net equity is falling, the reverse happens. And I want to just tell you, in August 2000 was the high in the S&P. I told you the story about the investment client we had in June of 2000. I was expecting a recession, and look at what happened. Now, when we talk about downturns in the market, sometimes it takes a very long time to come back to the previous peaks. So if you're buying at the top, whether it be the real estate market or the stock market, and it goes into the tank and then starts to recover from the lows, it might be a long time before you come back to your starting values. Okay. And if you look at in the Depression, it took 27 years to recover to the 1929 high, even though you had lots of volatility, lots of trading opportunities in there, but it's very tough to go through. The 1968 high took 23 years to get back to the high, right? My view is, and this is shared by Ray Dalio, who is the billionaire fund manager of Bridgewater Associates, the world's largest hedge fund. And I had the good fortune to speak to Ray in his early in the career when I was on the board of the trustees for the pension fund at West Coast Energy. We interviewed him to manage some of the money for the company, for the pensions. This guy is very bright. One of the things he counsels people is surround yourself with people that don't agree with you and have very, very pointed, heated discussions without taking personal offense to really find out what's true and then act on what you believe finally after the discourse to be true, right? He doesn't believe in being surrounded by yes men. We all have blind spots. And if the yes men are all you listen to, they know your blind spots, they never reveal them and you get sideswiped, okay? He thinks that we may have a lost decade in the stock markets. And I believe that. I really believe that to be true. It's one of the reasons I got out of the investment advisory business in 2016 is I could see the trouble coming, and the institutional requirements in the industry was that you could not really help your client with the rules they had about how much risk you can take and everything else, okay? So we're gonna have a tough time in the stock markets, in my opinion. This is the price earnings ratio, and you'll see on the right-hand side, in the first quarter, it was 26.5 times earning was the price ratio. And it's only been above that for very short periods of time. And that was prior to big downturns in the market. Typically, the price earnings ratio is much lower. The reason it's so high today is because interest rates are so low. Now, if interest rates go up, and at some point they will, that price earnings ratio is going to drop, which means for any level of earnings, stock prices are going to drop. Okay. And here's just another indication. You know, we've had in 1987, you might not remember the October 87 crash, Friday, Monday, down 30% cumulatively. In early September, Mike Ryan and I, the director and one of the original partners in Pemberton Securities, I was the director of the company at the time. We went to Europe and around Canada telling investment managers the markets were way overvalued and that they should get to the minimum levels equities that they are allowed to have under their guidelines and wait for a correction before recommitting. Well, what happens, you know, a few weeks after we get back, the market crashes. And the rest of the economy looked really healthy. So Mike and I had a meeting and I said, look, we should put out a report saying that there's enough of the price overvaluation taken out of the market that we should encourage people to get back in today. When this happened, and it happened so quickly, the Wall Street Journal had articles about economists calling for a depression. That was not going to happen, in my opinion. So I wrote a report that was distributed the following morning saying that the worst is out of the way, start accumulating equities. Well, it turns out that Monday close was the low, and it just continued to rise until the next correction. So, you know, being willing to take a position, risk your reputation because you believe the analysis that you've done is pretty good, you know, it pays off if you have an ability to communicate effectively with clients. So let's talk about housing. It's huge in the economy. Housing is very much affected by interest rates, and we had the peak in the early 80s and housing collapsed. Every time we've had an economic cycle, housing starts have fallen dramatically and then they've recovered, and they've recovered for two primary reasons. We had sharp drops in interest rates and we had surging employment. And the combination of those two made it easier for people to buy homes. And so housing starts recovered, and that's been the cycle. And I'll show you a chart later. Right now, we've got 1.5% 5-year mortgage rates. You can't get much cheaper than that. And if it is, it's because we're in depression. Okay, so be careful what you ask for. If you want lower rates, you're basically saying, I want a really weak economy, because you can't have these low rates continue when the economy is doing well. Now, if you look at residential investment as a percent of GDP, it's way out of whack right now. And if you look historically, whenever it gets out of whack, it comes back down. There's a concept in nature and in the economy called reversion to the mean. When you get too far away from what makes sense, It always comes back, but it doesn't just come back to what makes sense. It goes below to what makes sense. So you have this pendulum swinging. And right now, real estate is way overweighted in the economy. And a correction is about to happen. The question is, what are the triggers and what does it mean? If you think about it, houses consume a lot of materials. A lot of them are domestically produced: cement, plywood, lumber, you name it. You have a lot of employment. You have tradespeople, you have carpenters, you got all kinds of, you got truckers, you got a lot of labor, and the labor is fairly well paid, averaging between $26 and $40 an hour, right? They're not the low income personal service workers in restaurants, nail salons, and barbers and that kind of thing, okay? So when you have a correction in the housing market and these people lose their jobs, not all of them, but if 15 or 20% or 30% of them lose their jobs, if housing starts are down 30 or 40%, then you got a loss of income that affects consumer spending, right? I've talked to a number of restaurants. One is situated close to a lot of construction projects, and their customers are construction workers. Well, their customer base is going to disappear when the construction projects are finished. Those workers will go to another project somewhere else, and they'll go to the sandwich shops near the other work site. And this sandwich site is going to be struggling for customers because they're transient customers that are there for convenience because of a project that's happening. So whether you're working on a condo tower or housing development or commercial property, and you're dependent on them, once the project's finished, they're going to go somewhere else. If you look at the percent of Canada's GDP from real estate and related industries, this counts mortgage financing, realtors, right? This only goes to July 2000 or June 2017. It's probably higher now with the boom we've had in real estate. So we're looking at probably 23% of the economy. So if residential real estate doesn't do well, it's almost impossible for the economy to do well. Statistically, it just doesn't work, right? And if you look at a share, if you want to compare us to the US, up until the mid 2000s, we were pretty similar. You know, the trends were the same. Our magnitudes were higher than the US in terms of our share of the economy, but we've just continued to be way above the US. The US share dropped down because of the housing bubble that burst in 2008, 2009 crisis. Right? And that's what caused the severity of their recession. We basically skated through that period. We didn't have much of a recession in Canada. Okay. And again, I talked about employment. If you look at 7% of Canadian workers work in housing construction, and they're high paid. So if anything happens to weaken housing construction, which it will, that means high paid people will lose their jobs. And there are feedback effects through the economy. Okay. And we are so overvalued relative to rent or income or any other measure you want, that we just can't continue at these heights. We got boosted to these levels by foreign money, whether it was laundered money or not, it really doesn't matter. It's been primarily foreign money. And people turn a blind eye to the income verification. You know, that's why you have students on the west side of Vancouver living in, you know, $4 million houses. The banks were not doing a proper job of income verification because they wanted to place the mortgage. But I think we're going to see some of the rules change, as they already have. And if you look at housing starts, they just came out. They collapsed during the lockdown. We went from 218,000 to 164,000 in a matter of 3 months. Then they came back when the lockdown was eased. They dropped a bit in September, October, and they've come back. You might think, well, that doesn't look too bad. The trend is up, but that's too short a time frame to really understand. If you look at historically, housing starts have corrected very severely. I mean, we've seen 50% drops in housing starts from peak levels in past recessions. And I think we're probably going to have a 40% reduction. And it's not going to happen in 1 year. It's going to happen over a period of 3 years. When the tsunami starts to move, it picks up speed. Okay, it doesn't happen all at once. Okay, so we're going to see some negative effects from the housing. Now, let's talk about house prices. This is a chart they don't produce anymore because it's got some statistical anomalies in it. But anyways, if you look at this chart through 2018, it shows you how single-family homes in the Greater Vancouver region has dramatically risen. But the peak was back in 2015, 2016. Then we put in rules to limit foreign money, the speculation tax, and a few other things. So we've not really gone above that. We've seen condos and apartments do the same, townhouses do the same thing. But when we look at a chart like that, it looks like the squiggles are fairly minor. And we say, oh yeah, but that happens all the time. Oh, you live through it for 3 years or 4 years when your home is going down in price 15, 20%. It does not feel comfortable because it's no longer just looking at a chart. Here is part of that chart from earlier years. And what I did was, since I didn't have access to the data, I basically interpolated from peaks to lows and tried to guess at the time interval from peak to peak and the price drop from the high to the low. And what this shows you is that in 81, 84, there was about a 28% drop, but the peak to peak was 86 months. After that huge collapse, you hit the bottom about halfway through to the recovery to the next peak, right? To recover to the previous peak. If you look at 1990, we had 24 months peak to peak, and there's a 17% drop. This is the Hong Kong situation. When Hong Kong negotiated, when China took over, and they negotiated the 50-year takeover, a lot of people from Hong Kong left and they bid up house prices when it came to Canada. Okay. 1995, 99, 25% drop. Okay. And it took 94 months to get back to the previous peak. So when you think about history and when you recover in price, it's because people bid up the price of houses. And they were able to bid up the price because interest rates were falling, making the price, the mortgage financing easier. Well, where do you go when you have rock bottom financing? You either need an incredible amount of down payment capability, or you need very rapid growth in real incomes and employment to be able to bid up the price of housing once it's fallen. And I don't see those conditions happening. So when we have a correction in house prices, and it's anyone's guess when it's going to happen, it's going to be very hard to not stop the slide in prices. And they'll probably languish for a while. And we're going to have no huge surge because there won't be conditions. In fact, if we have rising interest rates in the future, even if they go from 1.5% to 3% for 5-year mortgages, it's going to be much more difficult to qualify for mortgages. So the arithmetic is not in favor of housing. So let's talk about growth. I told you that information that comes out from governments is to condition your attitudes. They don't get paid for being right. They're not putting all the resources at work to figure out the world and then share it with everybody. Okay. If you look at this table, this is the latest IMF forecast in October. And if you look at Canada, second to the bottom, we're looking at a 7% drop and then a 5% recovery in GDP next year. The advanced economies, if you look at after huge drops this year, there's a big bounce back next year. That's not going to happen. Okay, and I'll show you why. Who do you believe? Every forecaster risks being wrong. Okay, the question is, for what reasons are you wrong? Right? If you look at the Liberal Party platform for Canada's projected deficit during the election campaign, that's the red line. They expected by this year to be a balanced budget. A year later, they revised their forecast down. Now, and a year later, down again, right? And they say all new information has always come out, right? But the reality is that that first projection was just totally untrue. And everyone bought it hook, line, and sinker. If they'd been truthful, they may not have won the election. And we know that there are two rules in politics. The first rule is to get elected, and the second rule is to get reelected. Now, if you look at the latest government statistics in the report that came out, their numbers show a 5.8% drop this year and a 4.8% increase next year, and then reasonably strong growth rates of 3%, over 2% in the future. Again, I'm going to try and convince you that that's not likely to happen. Same with the unemployment rate. In the red box, you'll see the unemployment rates are trending down sharply. And if you look at the US, people have the same expectations for the US, a big surge next year after a drop this year. But things are going to get worse for the US, much worse, okay? Even with the vaccine. And we are tied at the hip to the US, and I'll show you that. So to understand how the economy is going to function, you really have to understand what's going to happen to the consumer, because they represent 57%. What's going to happen to government spending? That's 20%. Fixed investment is 21%. Housing itself is 7%. Business investment is 9%. And then you have exports and imports. Now they're both 32%. So they sort of cancel each other out because it's a net that matters. But the key here is that 32% of our economy is exports. That means that a large segment of our industry is involved in the manufacturing of things that are sold abroad. If the demand for our exports are not there, like we expect them to be or they used to be, that means the production side in Canada in those industries is not going to do so well, right? For things to be consistent. So I want to show you historically what's happened to the growth rates in Canada, because we all have very short-term focuses, and there's a saying that if you forget history, you're doomed to repeat it. So we really have to maintain a long-term perspective. Not that we look at the long term all the time, but we have to take our current statistics and recent statistics and our forecasts in some kind of perspective, and it can't be just in the last year. Okay. So these were very strong growth rates in the 60s and the 70s, okay? Productivity and employment and GDP. Then they slowed down dramatically in the 80s, and I'll tell you why. Again, we had a slowdown in employment in 1990s. We did about the same in the 2000s. And then 2019, weaker employment growth in 2%. So we went from 4 to 5% growth rates gradually down to about 2%. And the government's own forecast is that it's going to be much less than that in the future. So let me just get rid of this here. Show grid video. What's this here? I'm trying. Okay. So the question is, what's going to happen? The government had projections for the next 50 years. And I know we're not going to talk about 50 years. The next 5 years are really critical, though. Their forecast was for less than 2%, only 0.8% growth in employment, the slowest we've ever had. And that's assuming 1% productivity growth, giving us 1.75% GDP growth. Productivity growth, I don't think is going to be that high. Our companies do not invest properly. Now let's talk about the economy in the more short term. You can see by the bars here that we had these two very large declines in the first and second quarter. And if you look at history, they just obliterate anything that's ever happened historically. And then we had the surge in the third quarter. Question is, what's going to happen in the fourth quarter and next year? And if you look at my, when I did this forecast in September, my numbers came out. I had expected a 45% rate of growth in the third quarter, and then 1.2 in the fourth, and a big drop in the first, and then basically stagnating after that. And what that gives us is basically a flat economy next year and a slightly positive economy in terms of growth in 2022. Not very good numbers. If you look at my recent forecast, the actual result was 40.5% growth in the third quarter. And I'm looking at basically flat to 0.5% growth, maybe maybe it should be negative growth in the fourth quarter of this year and negative numbers next year, very minor negative numbers. And that reflects weakness in consumer spending and investment, particularly housing. Okay. And what it gives you is growth numbers that are negative for next year and barely positive for 2022, not anywhere near the numbers the government's showing right now, right? I mean, they're just far from it. And it doesn't take a lot to generate a big leap of faith to generate these numbers. If you look at the government's own numbers in that fall economic statement, in the first quarter of next year, they have in their pessimistic case, a small drop, and then it comes back in the second quarter. I just don't think things improve that fast. Momentum builds up in the economy, both on the upside and on the downside. Okay, and in the stock markets, we don't have these very rapid adjustments, right? Humans don't react that way. And you can see that their growth rates in their pessimistic case is 2.9% for next year. And I'm basically zero. Big difference. Now, I think a lot of companies are going to be looking at these numbers and they're going to realize things are probably going to be worse than they're led to believe. And so what does a CEO do? He starts to revise down his forecast for his company and get rid of costs, which are employees. Again, to show you in context here, the growth rates of the economy have continued to drop, and they're going to continue to drop further in the future. And if you look at the 5-year growth rate from 2017 to 2022, it's basically minus 0.4%. The government's own numbers were 2%. Okay. And from 2019 to 2024, again, it's a negative. So it's going to take, we have 2 years, maybe 3 years of declining growth and a couple of years of rising growth that is modest. Tough business environment, right? Now let's talk about some of the longer term things that are disadvantaging Canada, because this is important to understand. We're a resource-based economy, and we live in a digital world. And we just don't have the products that people want. I'm out of time here. I've enjoying too much trying to educate people rather than getting all my message through. But again, we wanted to get away from the US. In 1972, we had what was called a third option. Mitchell Sharp, the Liberal Secretary of State, says we have to reduce our dependence on the US. They were 70% of our exports at that time. Now they're 76%. So after 48, After 48 years, we're more dependent on them. So governments cannot make these massive changes in the economy, like I said before, because the changes come from businesses and from consumers. And governments change. They're a hostage of the election cycle, right? And the reason we're more dependent on the US rather than less is that when the Mulroney government came in, he wanted closer ties with the US. So the whole policy changed. Forget the third option, right? But anyways, I should probably just stop here. There's a lot more I can go through, but we just do not have what the products that the world wants. If you look at our export recoveries in previous recessions, we never recovered to our previous level prior to the recession. It's not going to happen this time either. If you look at Canada's ability to export, look at this chart here. From 2000 to 2018, our gross exports of goods and services in Canada rose 66%, the lowest of all these countries. We just don't have the products that the rest of the world wants, and we don't have the competitiveness that we need, okay? We don't have a winning and innovative culture. We aspire just to survive and get along. You know, the Canadian motto is peace, order, and good government. We want to be accepted by everybody. We don't want to rock the boat. I mean, I've been part of many groups, and I've been the thorn that tells people what's going on when they don't want to hear it. And people don't appreciate that. So the desire to be accepted is a huge factor in us not doing what's right. Don Matthews, I'm sorry, Don Drummond, who I know very well, he was the Assistant Deputy Minister of Finance for David Dodge in the government. David became the governor of the Bank of Canada, and Don Drummond went to work for the TD Bank. He retired from there. So he's talked to many executives in his role in government and as chief economist. And in 2013, this is what he said. He perceives the unwillingness among Canadian businesses to invest capital as part of a problematic and long-term trend rather than simply excessive prudence, right? So this is a long-standing pattern. On average, the stock of machinery and equipment per worker in Canada is between 50% and 60% of what it is in the US. And it's been like this for a long time, and it'll continue, okay? And more broadly, Don says, look, Canadian businesses are accustomed to operating in an environment that is sheltered from competition. And as a result, they don't accurately perceive the risk of being too cautious and of failing to exploit opportunities and available resources. And this holds also for small businesses. And I want to encourage small businesses in my next Zoom meeting to consider an innovative solution to their plight, which will be huge for them. Well, I'm going to stop. I have more, but I don't want to go past the time that we have. I can always continue this at another time, unless people want to continue for another half an hour. Leave it up to people, because some of the key things that you need to know about our economy that's going to impact the future have yet to be said. And I was a poor manager of time here. Scott, are you there?
Yeah, hi, George. Thanks very much. Yeah, there's so much to absorb. I'm happy to continue, but it's up to everybody else. I know everybody else has a hectic schedule, so we can always set up another time if you'd like. And then
if the people that are here, there's so few people, if they want to stay, we can continue. And then I can do a totally different new one to a new group of people next time, and I'll make sure it's shorter. But if the people have to leave, I totally understand. So why don't we just see what they say?
So far, I've had a vote to continue going. So yeah.
Okay.
George and Scott, I have to get going. I've got another meeting to attend, but appreciated the information so far. And perhaps if this recording is available, I can catch whatever last bit that will be presented. And George, I look forward to the next Zoom meeting that you are going to target, focused on the small business.
Okay, great. Thanks, Abby.
Thank you.
I really appreciate your attendance.
All right.
Thanks, Abby.
Okay.
Yeah, thank you, George. This has been very, very interesting. I've really enjoyed it. How much longer do you think you have?
I think I have about 15 to 20 minutes.
15, 20 minutes. Okay. I'm going to hang in there. I enjoy what you're saying here. So I'll hang in.
Okay, thanks, Yvonne. I appreciate it. Okay, so we have a culture here of not taking a lot of risks, and we've never needed to take a lot of risks because we were protected. We had trade agreements, and we had, if you look at the resource industry, we had all kinds of perks from government. It was really not necessary for us to take a lot of risks. We didn't have the desire to be number one in the world. We were just making good money. So here, and this is the Deloitte report. And this is what really, I mean, I tried to mention this to the Surrey Board of Trade years ago. And one of the reasons I left, I was on the Tax and Finance Committee, is that I knew this was going on from all my interactions with people like Don Drummond and other executives. And there's just no courage in the Canadian executive suite on average. There's always great people in every group, right? But we're talking about an average because the average in aggregate determines the whole economy. So far too many Canadian companies lack the courage necessary to make bold decisions in the face of uncertainty and risk, concludes the report by Deloitte. Okay, they shy away from making key investments and executing dynamic strategies. They're unwilling to accept short-term challenge for long-term opportunity. And as a result, Canada's economy remains in low gear. Okay, the truly courageous are a rare breed. Based on a survey of 12,000 or 1,200 business leaders, Deloitte categorizes just 11% of Canadian companies as courageous. The majority are either fearful or hesitant. Okay, and so it's the lack of willingness to recognize what's ahead of you and to do something you've never done so that you can succeed, it's just not part of the DNA of Canadian business so far. I'm hoping that changes as the older business managers that are running our corporations leave and younger, more up-to-date people assume control. But there's no guarantee, because an organization changes all those inside. There's no greater example than politics. Every bright-eyed person that gets into politics and can change the world is changed by the system that they've entered into. So that happens in business too, okay? So if you look at the amount of investment, makes the world go round. It makes us competitive, it reduces our costs, it allows us to expand our capacity, it allows us to replace labor, be more efficient. But if you look at the non-residential business investment in Canada compared to our competitors, we're at the bottom, right? You can't, it's like, you know, you have to give your workers the tools to compete with, to build, to create. It's like sending people in an army to fight somebody that's much better equipped. You don't have much of a chance. This is the 2019 Competitiveness Index by the World Economic Forum. And I want you to notice two things. Of the pink charts, the pink bars here, if you look at the infrastructure, which is the third one, and the ICT adoption, we are terrible. And these are the areas that you need to be near the top today if you're going to survive in this world. You can't afford to be 26th and 35th, okay? If you look at the far right, the innovation capability, we're 16th. It's better, but it's not good enough for us because the US is first and they're our major competitor. Business dynamism, our ability to innovate, change your systems and all that kind of stuff. We're ranked 12th, which is good compared to our overall ranking of 14th, but we can do better. And if you look at where our business investment happens, that drives efficiency and productivity and future employment, you can see from 2012 to 2017, residential structures were up 12.4% when the economy grew 11%. But machinery and equipment was down 4.7%, non-residential structures down 11.4%, and intellectual property products down almost 15%. Now that's not a message, I don't know what is. So what are the barriers to capital investment in Canada? If we look at business investment in previous recoveries, again, like exports, they've never come back to the previous peak level in the most recent recessions of 81, 82, 90, 91, and 2008, 2009, okay? And $150 billion in resource projects have already been canceled in the past few years. And the Frontier mine developed by Teck would have been $20 billion. They wrote it off after spending $1.2 billion. Now, this is something people have a hard time understanding. Why would they spend 20 billion, or why would they spend $1.2 billion and not continue? Because that money is now gone. But that's exactly why they stopped. They knew that they were not going to get a return on the next dollar they threw in this project. You can't get the money back you spent. So don't throw good money after bad. As difficult as it is a pill to swallow, that we've blown 1.2 billion, that's the price of taking a risk. So I got to admire Don, who runs Teck. He did take a risk here. But the company in the aggregate has not suffered dramatically as a result of it, okay? Now, the future development of resources, and that's our bread and butter as a nation, I think is really at risk because of Indigenous reconciliation. Now, I'm not for or against reconciliation. It's a fact that's given to us. Question is, what does it mean? So the First Nations essentially will have veto power over what happens on their lands. And most of the resources in this country are on their lands. And again, agendas play a powerful role here. The firms that want to develop the resources have an agenda. The First Nations have a different agenda. And now if they have ownership and control, they can influence and they can try and achieve their agenda. If you look at the railroad blockades last year and the action about the pipeline, you can see what we're in for, okay? And that doesn't mean we shouldn't have reconciliation. I'm just saying, given that we are, this is just the price that we're going to pay. We have lower cost foreign competitors that are going to take our market share, and we will have much higher costs of developing resources, even if we can develop them, because of tighter development standards and environmental concerns and all the studies. Like, I mean, it's amazing. And there's going to be slower growth in resource demand, particularly fossil fuels. And that's our biggest single export is energy. So Alberta has got a very tough future ahead of them. The biggest reason to invest in capacity is whether you need more capacity. And if you look at Canada's manufacturing capacity utilization rate, it's just fallen off the map because of the lockdown. Now it'll bounce back in the second quarter, but it's still going to be very low. And unless it gets to be close to 82%, there's not going to be a compelling reason for most businesses to invest a lot of money unless they're doing it to become much more efficient to maintain their market share rather than see it be taken away by foreign competitors. Corporate profits. When you invest as a corporation, you have to either finance it with internal cash, or you go to the capital markets for a share issue or bond issue, or you use bank financing. Corporate profits are slowing down. We had this big peak back here because of energy, but we know that's not going to happen in the future. And if you look at the non-financial debt in Canada, and by non-financial, that means outside of the banking system, what are the corporate world in Canada? What is the amount of the debt they have relative to GDP compared to the US? Canadian companies are way over leveraged, just like consumers are. So if you're going to rely more and more on external sources of cash rather than internally generated profits, you're going to be hamstrung. Okay. And businesses have the highest debt service ratio in the world. This goes up to 2018. Okay, so it's fairly recent. But Canadian companies have got a lot of debt. Canadian companies would rather invest abroad. Now, there's a good reason for that. We're an exporting nation, right? So when you produce here and you export abroad, you produce in a high-cost jurisdiction, you incur transportation costs to send to the end market, which is abroad. It makes more sense on the margin to invest in your end market, which is usually a lower cost production market, and you eliminate transportation costs. Our business confidence index, again, plunged during the lockdown and then came back and is now falling again and will continue to fall because of the partial lockdowns back east. And we could have it here in BC as well. What people don't understand, I think, well, is the impact of globalization. Now, I have to confess, when I started my career in 1974 from Macmillan Bordell as their corporate economist, I acted on behalf of Macmillan Bordell to argue for free trade agreements, okay? And the logic was that, you know, if we can produce more abroad, we can lower our total costs and we can improve our profitability. We have wider access to foreign markets. We can sell more abroad, which benefits the company and our employees here. If we import more and we have lower tariffs, it lowers our cost of production because most of the equipment we use is imported, okay? So I was all in favor of all that because I saw it as a win-win-win. The problem was corporations did not do what we thought. They didn't just create a marginal facility abroad to service the foreign market. They junked operations domestically and replaced them abroad to dramatically improve profitability, but at the expense of workers and the tax base. And so really what the trade agreements were all about was to facilitate the improved profitability of corporations globally And it was a means to have a wealth transfer from the employees in the developed world to the employees in the developing world and to the executives that ran these multinational publicly traded companies. You know, we hear people complain about their pay, and the executives always tell us, well, we're not productive. If you want to earn more, you got to be more productive. I even heard Jock Finneson say that in an interview. And I know Jock well, I love him. He's a great guy. We've known each other for decades. But it just shows you how the myths that we've had, they endured despite data to the contrary. You know, up until the 1980s, compensation rose along with productivity growth, not in tandem, but in the same direction and reasonably well. But since then, we've had a huge divergence in productivity growth and compensation. And that means it's been a return to capital. It's been a return to profits and to the shareholders. And the executives that run these companies, their compensation starting in the 1980s and early 90s, when the compensation changes to be more stock option induced, they had a huge incentive to goose the profitability of their firms and reap huge personal financial rewards through stock options. And here's another, like we're told, a rising tide raises all boats. That's the trickle-down theory. It's the capitalist view. It's the conservative view that, you know, if the economy does well, everyone does well. Not equally, but everyone does well. Well, that hasn't happened in the last 30 years. This is a professor in the United States that questioned this rising tide theory and calculated the returns to economic growth to income classes, the decile groups. And so after the Second World War, this blue bar shows the, excuse me, shows you the returns to the bottom 80% of the population. The top 20, excuse me, swallowed the wrong way. The top 20% got much less of the share of total income growth. The subsequent recovery, same thing, but the bottom, the bottom 80% got a little bit less. And as you go through all the recoveries, when you get to the 1980s with the trade agreements, you find out that the top 10% got more than 100% of the net gains. And that's why consumers have resorted to debt to support their lifestyles. They were not willing to reduce their lifestyle. And the idea was that they all thought that their use of credit was going to be temporary. They did not realize that this is a permanent situation created globally by trade agreements and the behavior of corporations, that they would never recover their employment and their income fast enough to pay down the debt that they used to finance their lifestyle over the short term, thinking that it was just going to be temporary. And if you look at the actual income growth, okay, earned income, the average from 1982 to 2010 is probably the same if you go to 2019. The average you can see was very, very minimal for the US and Canada. Canada is black, gray is the US. But if you look at the bottom 90% of the population in both countries, they got nothing in real terms. The big beneficiaries were the top fraction of 1%, okay? And what does that mean? That, you know, these global trends will continue. So there can't be a realistic expectation of significant employment income growth. And this is one of the reasons why governments had to come up with raising the minimum wage. Corporations were just not willing to pay. And they argued they couldn't. So the government said, well, you're going to have to. So they've mandated minimum wages, and they will continue to go up. And if you look at what that really means, Canada's middle class, we talk about the middle class being carved out. You can see that here in Canada. People are going from the middle class either into the lower income area or they're going into the high income earning area, but the middle class is falling, okay? And this basically coincided with the inflection point in 1980 when we started having the massive deregulation and trade agreements enacted. So consumers confidence has been hammered, and it will get hammered further in the next 3 or 4 months with the COVID fight, even with the vaccine. And that is not good for retail sales. In the US, we just got data today for the month of November. Retail sales were down 1.1% after the 1.5% gain in the previous month was revised to a minus 0.5%. So we've had 2 months, October and November, of declining retail sales in the US because of what's happening there with the virus. In Canada, the latest data we have is September. We're much slower in releasing data. But when we get our November and October and December data, I think it's going to be bad too. And it'll be bad going into the new year. Okay. And it creates a very low starting off point for growth when it does resume. As a small business owner, you have to understand your consumer base. And a lot of people are pessimistic about the future. If you look at the black bar, it's people that think that there will be a lasting impact on the economy and show regression into a lengthy recession. Over the last 7 months, the percentage of people that have become pessimistic amongst the consumer base has risen to 29%. Okay, the number of people that are pessimistic or optimistic has dropped, and most people think that it's going to last for only 6 months to 12 months. Are they in for a surprise? Okay. We have a lot of income and debt, and that's going to hold us back. In the second quarter, we're going to have some weird numbers. We can't really interpret these numbers because spending dropped. A lot of people did not spend money, so debt probably dropped, but maybe it actually went up because of mortgage financing as housing came back. And the income numbers were very poor because of lost employment, but it was made up by transfer payments from the government. Okay, so it's going to be very hard to interpret the latest numbers when they come out. But the fact is that there's too much debt in Canada, and the banks are saying now that there are just hordes of cash in consumer and business accounts in the banking system, and the government's hoping people will spend that cash. Well, I hope they don't, because if you spend that cash, you're going to go right back to relying on debt, and that's not sustainable. If people use that cash to pay down their line of credit or their credit cards dramatically, they risk the bank reducing their credit limits. So it reduces their future options for capital access. So it's going to be tough. Consumer finances continue to deteriorate. If you look at this, the numbers are not huge, 0.1 to 0.9% per thousand. But the thing is, the trend is going up and is worrisome. Consumers now are very conscious about how they're going to spend their money now. 40% are becoming much more mindful of where I spend my money. Now, this is a huge opportunity for small business because there is empathy and sympathy and recognition of the plight of small businesses. And when I talk to my next Zoom meeting about this program for small businesses, that can be used to capitalize on the support we have in the consumer's mind for supporting small business beyond the COVID situation. And we can get a lot more of the consumer's dollar going to small businesses rather than large businesses. Okay. They're looking for ways to save money when shopping. 36% of them. Okay. So we have a huge opportunity here with a change in the mindset if we play our cards right. The labor markets, we still have a lot of unemployed people, and we're going to have more unemployed in the next 3 or 4 months because the month of December will probably show a decline in employment. Okay. We had these are the numbers of unemployed, right? We had a huge spike in the number of unemployed in April and May, and then it's been coming down sharply and then more gradually. And I think we're going to see more unemployed in the next little while. Now, here's a chart. Remember that budget projection deficits that I showed you from the 2015 projection by the Liberals? during the election campaign. If you look at the COVID recession recovery in the unemployment rate, look at their forecast. They're expecting the recovery in the unemployment rate back towards normal to be much faster than any previous recession ever that we've had here. Why in the world would they do that? I don't think it's true, but they want people to look at it and say, oh yeah, things are going to be okay. If they forecasted a recovery that was anything close to historical, when conditions were better, people would not like that, right? They want to see something better to keep their hopes up. So, you know, we still have 636,000 people, fewer people working today than we did at the peak. And that number is going to increase over the next 3 or 4 months, possibly longer. The number of months to reach employment pre-recession peak. In their original survey of private sector economists, they thought it would take 24 months, which is the fastest of any of the previous recessions. Again, the private sector for economists are, they use the same econometric models the government does that I used to use. They're quarterly models. They're incapable of forecasting major changes because they're based on the inertia of the last 20 or 30 years of data points, okay? The COVID crisis extended much higher number of months, much greater number of months, 4 years in the escalated restrictions case from the Department of Finance. It could be even longer than that, 5 years or more. And here we can see the previous recoveries in employment. See, the 2008 is the top one. We hardly had a dip in employment because we skated right through it. And a lot of people were patting our backs saying, see how good Canada is. Our financial system is much stronger. We didn't have the, excuse me, the mortgage collapse, and our economy didn't suffer as a consequence. Excuse me. What they don't understand is the banks in Canada had lots of loans, interbank loans with the US institutions. And if the Fed had not bailed out the US institutions, our institutions would have fallen as well. Now here's, excuse me, I swallowed the wrong way. Here's the what's facing us. As business executives redo their budgets for the next year or two, and they see that their revenues and profits are going to be much lower than they thought, they're going to start cutting jobs. They're also going to be incentivized to merge because the CEOs who want their compensation packages need to have growth in earnings per share in order to receive the compensation. But it is no organic growth because of the economy. You buy another competitor, you get, excuse me, economies of scale. And what happens when you merge two large companies? A lot of high paid people at the top end are redundant. So in normal recessions, there's a much sharper drop in high paid people than low paid people. Right now, because of the shutdown, most of the unemployed were the low wage earners. The large employers still, even though they were on reduced work, a lot of those people could work at home. They still were employed, were still earning income. But now many of them will become redundant as companies have to cut costs. And that's a euphemism for labor. And we have a situation where there's no stability in employment anymore. We're in the gig economy. My two youngest sons work in the movie industry, so they're dependent on getting a new film, new TV series, excuse me, after the one they're working on finishes. Excuse me, it's not COVID. And this is my last chart. There's going to be an accelerated adoption of automation. And if you look at this, is for the US. And it was done in 2016. And it shows that by age group, the black numbers are the the percent of, or the probability of automation being a factor affecting the employment of people in these age groups. So you're looking at goes from 75% in 16 to 19 down into the mid 40s for the people in the prime earning times of 35 to 54. Okay, so they're all at risk, and the probability of the percentage of jobs being affected are in the 20% range. So you do the arithmetic, and you can see it all around. You know, even professions are losing out to automation. You know, they've got software that'll diagnose cancer better than a physician. They've got accounting software that replaces accountants. They've got software that will do legal searches way faster than and more efficiently than a clerk in a law firm. They've got analysts. They've got software that can do analysis of companies much better than an actual person. So people are being replaced, and we get machines replacing people on the production line, and that's going to be accelerating. And so there's going to be some problems in finding a job and keeping it and being paid well by the people that do employ you. So I'm not a pessimist, okay? I never have been. I've forecasted recoveries, and I've forecasted recessions, and I've forecasted the stock market recovery, and as well as huge downturns in the stock market. My forecasts are a function of the data I see before me and an understanding of the behavioral response of the players in the economy. I believe virtually any problem can be overcome. That's the optimistic side of me. But the thing is, you have to know what the problem is and how severe it is if you're going to have a chance of figuring out a solution. And so that's my message. I just, there's going to be some tough times ahead, but it's not the end of the world, because if you know what's ahead, you can make decisions to overcome them. And I want to help small business overcome this environment and become very prosperous. And that's the subject of my next Zoom meeting. And that's one of the things that's my mission today. I mean, I should be retired. I'm 71 years old, but I told my two youngest sons that they're going to have a long life, and I like it to be in this country and they don't have to run to another country. And I want this country to be able to support them in a lifestyle that I've had. And the only way that can happen is we have a strong economy. And that means we need strong small business sectors. It's that simple. So I really appreciate those that stayed and listened. I hope you got some value out of this. And if you have any questions, you can always contact me personally. We'll be announcing my next Zoom meeting very soon, where we'll talk about the solution to this challenge. Thanks very much, Scott.
Thanks very much, George. I really appreciate it. It's an amazing amount of information to absorb. Does anybody have a quick question at this point? No, I think we're good. I think we have a lot to absorb, and I'll let everybody know about a follow-up session as well.
Okay.
Great. Thanks, everybody.
Okay. Thank you very much. And thanks for hanging around, Andrew.
Good. Thanks, Marty.
So stop share.
Perfect. Thanks very much, George.
Oh, you're welcome. You're welcome. I know I went overtime. I get enthusiastic about. I have this thing about, don't just take my opinion. Understand why my opinion is the way it is. Then you have a better chance of maybe believing the same thing.
Yeah. What's fascinating is Andrew is a realtor, so I didn't know if he was going to have any comments to make when you're talking about the real estate market.
Oh.
But he didn't. I think, well, he definitely wanted to stay, so he was enjoying the presentation, that's for sure.
Oh, that's good.
Yeah.
That's good. That's good. Okay, super.
Perfect.
Okay, we'll be in that. I guess people that want to listen can just listen to the recorded version, right?
Yep.
Okay.
Yep.
So I think my next session is going to be on the small business cashback program.
Yeah.
And identify how it can address all of the issues I brought up here.
Perfect. Yeah, because I mean, it's good to know the problems, but if we can find some solutions as well.
Yeah. Because without knowing the solution, the tendency is people will just continue doing pretty much what they're doing, making very minor changes on the margin that don't really change the fundamentals all that much.
Yeah.
They just basically end up treading water.
Yeah.
So, and I that's not good enough.
Yeah, for sure.
Yeah. Okay, well, thanks. I appreciate that. I'm sorry I had a couple of coughing fits there, swallowed the wrong way, but
I mean, you talk for an hour and a half. It's normal.
yeah, okay. Okay, when do you think, is there time for me to do a Zoom meeting before the end of the year, but as early as possible? Because if people want to do this, I'm going to offer them a big $300 discount. And I was thinking that I might put that out in that, the merchant thing you said? Yeah, so I'd like to do that.
Okay, I probably can. I mean, the trouble with being so close to Christmas, I don't know how much traction you get.
Yeah. That's true.
But well, let me talk to Tamara, my marketing person, see what kind of schedule, because I know she's got some stuff lined up for January, because January might be good too.
Yeah. Okay,
Great.
Have a good day.
You.
I got my car back and it works.
Oh, perfect.
Yeah,
Well, it works. That's all that matters.
that's right.
We
Okay,
got
thanks a lot.
Yeah, thanks, George.
Okay, bye-bye.